So the Paladin situation is exactly the type of situation that I joined the firm like Kingwood Mallisons to be a part of. Really, you got this international client, this Australian listed company which had the courage to build mining assets in Africa and in Canada, to borrow money from the French government, to borrow money from Asian investors, and we as lawyers are able to go global with them. So we have our Perth mining team helping them with their African mining assets. We have our litigation team in Europe keeping the French government as a major creditor at bay. Our debt capital markets team in Asia negotiating with the bondholders, and our restructuring team led in Sydney coordinating this major restructuring. So Paladin was always going to have to remain listed because the creditors were going to insist on swapping their debt into equity which they could sell, and as a result it had to be on a listed exchange. Paladin itself was listed on a number of exchanges around the world, Australia, Toronto, Namibia, and it also had its debt listed in Singapore. So maintaining all these listings during a complicated restructuring was an extreme challenge, because even though the equity would have appeared to be worthless at the point in time the company went into administration, its debt was trading on the bond markets, and so we were under continuous disclosure obligations all the way through the administration, keeping us under extreme pressure to communicate to the market and balance the interest of negotiating very sensitive matters.
I think it was very significant for corporate Australia. We went through a solvent restructuring process, and that really put us in the mode of engaging with our creditors and working out what their touch points were, who was going to work with us on a restructure and who wasn't. We really had established that the company was going to be supported in a evolution in terms of a debt for equity swap. We had discovered that the company is financeable, so we had sources of finance going forward if we were to implement a restructure. But then we had one or two stakeholders that were unable to, let's say, support or understand that what we were going through in terms of our solvent restructuring was in fact achievable, the outcomes were achievable, and so they were unable to support it. So the key thing with us and why our deal is so significant is we then appointed the voluntary administrator, having done all that work. And so I think it's quite a unique voluntary administration process for corporate Australia. In my mind, it's a little bit like a US style bankruptcy where the stakeholders generally know what they're trying to achieve, but they need to go through the court process in the US to deal with certain creditors or certain contracts or issues. I think it was incredibly important. Okay, now when you run a public company, in the ordinary course of business, you tend to engage a lot more with your equity investors than with your creditors. And when you're in a situation where you're not sure you're going to meet your liabilities, or there's some chance of having to restructure, you think this is going to be, say, a very devastating or hostile situation that you're going to end up in with your creditors. I think what we did at Paladin is we just took it on the chin, and we decided to go out and engage with our main creditor group, which was our bondholders, really quite as early as possible, even when there was all sorts of other solvent, other deals in progress that would have kept the company solvent.
Well, the bondholders here had very significant exposure to Paladin, and their bonds were maturing, but the company was not in a position to repay those debts. And there was a number of transactional steps required to deal with that. And because of the company's solvency position, it was necessary for administration. And then out of administration, a strategic pre-planned deed of company arrangement proposal was critical to the company emerging. We were able to work closely with the bondholders and also their advisors to deliver that solution. There were also disputes going on in the background, so it was quite an interesting contested matter, moved quite quickly, but the deed of company arrangement proposal was critical to the company emerging from administration unscathed. The company spent a lot of time outside of administration dealing with creditor groups in circumstances where its solvency was in question. It had to develop courses of action to deal with those challenges. The directors were under pressure with insolvent trading, and the safe harbour was not in effect when that was going on. But what we found was that our advice didn't really change. I think with the safe harbour coming in, we would have probably given the same advice. And I don't think things would have changed for the directors. They might have felt slightly more comfortable. In relation to ipso facto, it's a really interesting question as well, because there was a contractual trigger in favour of China Nuclear in their joint venture agreement that wouldn't have been operative if ipso facto was in effect. So if that contract had been signed after 1 July of this year, 2018, we would have seen that wouldn't have been a factor in the restructuring, where in fact, because it was before ipso facto came in, it was before 1 July 2018, it was an enormous factor, very influential.